6 numbers that you need to know to ensure your long-term financial security. And no, we're not giving out lotto numbers on the program today, but we'll talk about the numbers that you should be aware of if you want to have a successful retirement. Plus, we'll give you some tax planning ideas to think about for the year 2020. Basically 3 months left, maybe closer to 2.5 now in the year. There's certainly some things that you need to be thinking about, considering as it relates to your taxes and your finances. So we'll talk about all of that on the program this week. Welcome, of course, to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you here Sunday mornings at 9 a.m. on the News Radio Orlando network, along with 96.9 The Game. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web, with over 12,000 downloads of our episodes at last count. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you improve your life with a successful and cost-effective financial plan that provides you with peace of mind for the future. So before we get to all of that, we would be remiss, of course, this close to an election, if we didn't include some general election perspective. I don't know about you, but certainly we're getting a lot of questions about, well, what if this happens or that happens? And we thought it would be good to sort of at least share some perspective. And bottom line, don't give up hope on the process. Make sure you get out there and vote. The reality is that, yes, we have a polarized political climate, but understand that there's a lot of precedent for this country ultimately working together to solve the problems. And I suppose that's the crossroads that we find ourselves in. And I think when we look at history, what most people fail to appreciate is, more often than not, what drives any administration is sort of the headlines or the economic events or the foreign policy events that occur that make a much bigger impact in terms of what their focus can be. And we certainly think that COVID and the economic impact of COVID is going to be a big driver of whatever happens over the course of the next 4 years. But let's not forget that there are, in fact, shockingly, some areas where I think we can see some overlap between the Democrats and the Republicans, and particularly a ability, when it comes down to it, to actually come up with at least some form of a solution. And you may be sitting there saying, well, how can this guy actually say that in today's environment? And I guess I look no further than the fact that you had 5 different pieces of legislation, 6 if you want to include the Secure Act, but 5 different pieces of legislation that were passed this year with bipartisan support that had to deal with COVID. So it's nothing like a crisis like that helps to unite folks when it comes to, hey, we need to come up with solutions. And lo and behold, we see ongoing communication or conversation in Washington right now about potentially a 6th such passage. So before you give up hope, I guess, on the political process, understand that there's a lot of examples, even this year, where folks on both sides of the aisle have gotten together to try and accomplish something legislatively. So just be aware of that. And I guess that leads us to sort of our 3 areas where we see a tremendous amount of overlap, if you will, or should I say, focus on what needs to be done. And of course, first and foremost, of course, is COVID and the economic impact that comes with COVID. And ultimately, that's going to dominate the 2021 2021 legislative agenda, probably the 2022 legislative agenda, and beyond. And certainly I think we'll see some form of additional stimulus package. There's a lot of these businesses that took the payroll protection money, the PPP money, the loans to help make payroll, but now all of that is ending. Businesses are certainly still seeing an impact on their top line, if you're in the restaurant or retail business in particular. And at some point, you're making the decision, hey, wait a minute, I just can't, move on in this capacity. Even if I am getting money, I'm not getting any money revenue-wise. So ultimately being forced into make those very difficult decisions. I mean, back in April, you actually had folks on the GOP side of the aisle proposing that the federal government cover up to 80% of wages of employees infected by the COVID pandemic. So definitely you're seeing some blurred political lines on that, and you can certainly look no further than the 5 different pieces of legislation that have been passed, the PPP, CARES Act, all of the related bills and legislation that passed to say, okay, wait a minute, these guys really can, when it comes right down to it, not behave like complete polar opposites. Number 2, on that list of sort of where I think you'll see overlap and what will dominate the headlines is the notion of China. And no, not the virus. It's really more those issues about trade and intellectual property and jobs and manufacturing. I think both sides are coming to somewhat of the same conclusion that China really isn't our friend. I watched the vice presidential debate this past week, and one of the questions that was put to both vice presidential candidates was, well, how do you classify China? They're our friend, our foe, our adversary, and none of them, of course, as good politicians are, gave a direct answer on the question. But I think both parties understand that China's not really our friend. You can look no further than the theft of intellectual property that's been happening over the past several decades. That is a issue that I think both parties are starting to really understand and appreciate. And then number 3, and I think we're starting to hear and see this, is that technology, particularly big tech, is going to have a much higher level of regulatory scrutiny on it. Both parties have expressed frustration about big technology, its reach, its power, the information it has on every American. And so we would expect more antitrust, tougher regulation, and greater oversight on those technology companies. And I think those are the areas of overlap, if you will. Obviously, there's disagreements between the party. That's why we're having an election that is got 2 candidates that are proposing different solutions and answers to these problems. And I think really the big differences or the big disagreements sort of boil down into 3 different categories. First and foremost, of course, is tax policy, right? I think that's probably number 1 on the list. I think the Democrats favor raising taxes on corporations and the wealthy. The reality is, though, that there's more to it than that on both sides of the aisle. So when we get back, we're going to kind of touch upon where the disagreements are, and most importantly, what's the impact on your money. So we're going to take a break. When we get back, we'll continue the conversation, touching the third rail, talking a little politics, trying to give some perspective into the crazy political season that it is. Coming up next here on the program. The program, we're trying to talk a little politics, and that's always dangerous when you try and talk politics, but we're trying to point out that even though it seems like we are highly polarized, the reality is that both parties do have some commonalities. They certainly have some disagreements. But at the end of the day, what's going to drive the legislative agenda, in our belief, over the course of the next couple of years is really more what's going on in the headlines rather than anything else. And we see that time and time again throughout history where the events, whether they be foreign policy related, economic related, or other, those headline events really drive more of what the focus is during any presidential term. And of course, this year presents a once in a lifetime problem in the form of the COVID pandemic. So we think a lot of the focus is going to be on that. It has been, shall I dare say, refreshing to see the bipartisan legislation that actually has come out of, let's not forget, there's been 5 different pieces of legislation that have passed in a bipartisan manner that relates to the COVID pandemic. So don't give up hope on the ability of Americans to come together in a moment of crisis. And so certainly we think that there's some agreement on both sides in terms of the COVID pandemic and what we need to do going forward, particularly perhaps another round of stimulus. Maybe they don't agree on exactly the scope of it, but ultimately a second round of stimulus. China, certainly not our friend, probably more our foe. Clearly issues we've got to deal with there. And then lastly, big tech, perhaps getting too big. I think both parties would say that they're a little nervous about the reach of big tech. So where are the areas of obvious disagreements? Well, we'll get to that next. Welcome, of course, back to the program here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Central Florida's longest running radio program, coming to you Sunday morning here on the News Radio Orlando network, along with 96.9 The Game. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So if you're not a subscriber to any of those channels out there, whether they be iTunes, Spotify, or YouTube, make sure you subscribe to us. Just simply find us on those social media channels at Nelson Financial Planning, or go to our website, nelsonfinancialplanning.com, to get connected directly to our channel on those various social media networks. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary, where our team of certified financial fiduciaries stands ready this week to help you improve your life with a successful yet cost-effective financial plan that helps provide you with peace of mind for the future. So where are those areas of disagreements? Well, I think the areas of disagreements between the two political parties these days break down sort of into 3 different categories. Number 1, of course, top of the list, tax policy. The Democrats obviously looking to raise taxes for those that make above $400,000. The Republicans prefer to keep them the same. One comment on that: if you look at these tax proposals, for the most part, it would accelerate a change that is already slated to happen in 2025. Most people forget that a lot of these tax cuts that happened a couple of years ago actually had some sunset provisions in them that occurred in 2025, meaning in 2025, you're going to go back to those rates that were in 2017 and before. We may very well see an acceleration of that timetable, meaning you revert back to those rates. To the extent that that happens, that's probably the biggest area of difference on the Democrats versus the Republicans. I would submit that I don't know that you're going to see much movement initially on that, because it's really hard to raise taxes during a tough economic event. So stay tuned, of course, on that. Next is immigration. Immigration is an issue where both parties obviously disagree, looking for paths for citizenship, who can come in, who can't come in. And then, of course, lastly, let's not forget, we've got that whole Supreme Court thing going on as well. So what are the investment implications of all of that? And the reality is that we think from a stock or equity perspective that stocks are far more likely to benefit under a low rate environment rather than any particular policy movement or shifts on the administration side of things. So remember the old expression, don't fight the Fed. We think that certainly applies here, regardless of the outcome. In the same vein, bonds, on the other hand, the yields are likely to remain low for a long period of time. Low interest rates help, particularly when the government's racking up a bunch of debt. And then, of course, there will be, as there always are, sector impacts, right? Winners and losers among different sectors of the economy. For the Democrats, I think we can say that the benefactors would be the environmentally focused companies, perhaps discount retailers, smaller technology companies, healthcare plan operators. For the Republicans, the big benefactors there might be pharmaceutical companies, U.S.-based manufacturing, energy companies, those types of things. So you can see where every sector is going to be potentially impacted, some versus others. Of course, that's why, bottom line, you have a diversified portfolio, and even most importantly, you remain consistent and diversified in your portfolio. So that's the political speak, if you will, just trying to give some perspective and perhaps explain that you don't abandon hope, because at the end of the day, I think there is more that unites us as Americans than separates us. And certainly I think in terms of the legislation out of Washington that we've seen, there's certainly been a meeting of the minds, if you will, in terms of trying to deal with some of the issues that have been created as a result of the COVID pandemic. And we think that that's going to be a big driver of what happens next in terms of the overall perspective. So something to certainly keep in mind on that. Speaking of governments and sort of the approach that we see in governments, one of the things that we have seen is this ongoing trend among governments, particularly state and local governments, to create their own retirement accounts. And this troubles us on a lot of levels because you already have options from a retirement perspective, whether that be a 401k, an individual retirement account, or Roth, that are all creations of the federal government that allow you as the individual to participate in a retirement plan of your choosing. Either your employer offers one and you can choose that, or if your employer doesn't, then you can go directly and have an individual retirement account or a Roth. Well, some states, and unfortunately it's a bigger list every year it seems, want a piece of that action. And so over the course of this past summer, Colorado became the 9th U.S. state to offer a pre-tax retirement plan to private sector workers who do not have access to an employer-sponsored plan. And that just boggles my mind, because why is a state in the business of offering a retirement plan when the federal government has already offered one that's been around for 40 years? An individual retirement account is available to anybody. I don't understand why the states are in this business of trying to offer that. I do understand. I think it's an effort by the states to try and capture tax revenue and keep track of money that you're putting aside to save for retirement, especially when you start to uncover and peel the layers of the onion that make up these state-sponsored retirement plans. Because these plans that these states are getting offered, and again, there's 9 of them now, that have very limited investment options. They have a limited contribution amounts. They have limited balance levels. Plus, at the end of the day, they're completely unnecessary because you could just set up an individual retirement account without any trouble at all. Our view on this, very simply, is that it is just a tax grab by the states. They want to keep track of that money. They want to know what money has come in, and they want to know that that money came in when you were working in that particular state. Because in order to have one of these state-run retirement plans, you have to be a resident or an employee, actually, of that state. So if I'm an employee of the state and I open up a state plan in Colorado, and I put money away as a Colorado citizen, and that saves not only on my federal taxes, but on my state taxes, what do you think is going to happen when I move to Florida, or where have you, and retire, and I don't want to pay any more taxes? Or I take money out and I don't have to pay taxes in Florida? That Colorado plan, I suspect, they're going to be tracking that. So make sure that when you look at these options, that there are other options out there that are available on a federal level that have always been available. So don't fall prey to it. We believe that these states, 9 of them so far at last count, that are creating their own individual retirement accounts that are state-based, are simply another way that now the states are getting into your wallet and nosing into your retirement. So beware of that happening out there in the country. We're going to take a break. When we get back, we will continue the conversation about numbers that you need to know here on the program. As we get older, there are all kinds of numbers that we need to pay attention to. Blood pressure, cholesterol, guys, The PSA number is also kind of important. What are some of the numbers, though, that you need to be aware of when it comes to your long-term financial security? Welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on Sunday mornings on the News Radio WFLA Orlando network, along with 96.9 The Game. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web, with over 12,000 downloads of our program. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this very week to help you change your life with a successful and cost-effective financial plan that provides you with peace of mind for the future. So what are those numbers that we need to be aware of? And we're going to give you 6, and it's not lotto numbers. So if you think your financial plan is playing the lottery, this isn't going to work. But these are numbers that you would be far better off getting a hold of and getting an understanding of, rather than going and buying that scratch off. So anyway, here we go. Number 1, make sure you know the number of your monthly cash flow. So what is that? Basically, money coming in and money going out. Keeping track of income, keeping track of expenses. If your expenses are more than your income, you have a problem. If your income is more than your expenses, then congratulations, you're able to save money for the future. How do you get better on all of that? Well, one word: budget. And in order to have a successful budget, you need to keep track of those income and those expenses that are occurring on a regular basis. So be aware that that's how you can get on top of your monthly cash flow number. Understand what it is, know that what it is, and if you don't like what you're seeing, then particularly if it's a negative number, you're not going to like that, then how do you actually improve it? And that's the process of keeping track of your income, your expenses, and most importantly, going through that budget. Number 2 on the numbers, and this one probably comes as no surprise, Social Security benefits, right? How much are you going to get in Social Security? That accounts for around 40% of what the average retiree generates in income. And there's a range of numbers, right? Starting at 62 all the way up to age 70, there is a different number for your Social Security benefit depending upon where you fall in those ages. Age 62, that number is going to be very, very different than it is at full retirement age, which is 67 or 66, depending upon what year you were born, on up to age 70, where it maximizes out. So know your Social Security age, and the reality is that it increases as you go through those years. So it's certainly important to know that. Just along those same lines, the third number that is always good to know if you're looking to improve your long-term financial security is what your retirement savings is, right? Social Security only providing 40%. What's going to provide the other 60%? That seems pretty clear, given that Social Security is not even going to cover the majority of your income in retirement. So what you need to do for those retirement savings is very simple. Add it all up from all sources of liquid investments. So liquid investments don't include real estate or similar types of investments that you cannot immediately convert to cash. When we think about retirement savings in general, it's really looking at those assets that you can immediately convert to liquidity. That's how you find that number. You add all of those numbers up, and then what you do is you divide by 25. That's the same thing as taking 4%. Divide by 25 is usually something that more people can relate to and mathematically. And so if you divide by 25, then that's the amount of income that you could reasonably get from your retirement savings. Take that number and then add it to your Social Security and any other sources of income that you have, like pensions or like your net off of any rental properties, and that will give you a good idea of what your retirement savings number is. So obviously those first three, retirement savings, Social Security, and monthly cash flow, are pretty important. Here comes the other three. Credit score. If you've listened to the program on a regular basis, we just a couple of weeks ago talked a lot about credit score, what it consisted of, how to improve it, things like that. We refer to the prior episode on our social media channels if you want to learn more about that. But basically, your credit score determines how much interest you're going to pay. And it's easy to order a free copy. Just go online to do that. If your credit score is below 760 within today's number range, then there's certainly some room for improvement. What's the single biggest way you can improve your credit score? Pay your bills on time. That's the biggest factor that influences your credit score. So make sure you know what your credit score is, because that affects how much you're able to borrow, or the rate at which you're able to borrow. And then, of course, hand in hand with the credit score, right, goes to knowing your debt number, specifically your debt to income ratio. That's important for things like not just mortgages and applications for mortgages, but for peace of mind as well. If your debt to income ratio is a high one, then that means you've got a lot of debt and not enough income to really cover it as comfortably as you would like. So in order to determine that, you've got to add up how much you owe, right? That determines your debt. If you add up the monthly payments that are associated with that debt and then compare them to your monthly income, that then determines your debt to income ratio. The lower the number, the better. So hopefully that means that if you're applying for a mortgage, you're keeping that number down below 35%. That debt to income ratio determines the flexibility that you'll have while you are paying that debt to have extra income to put away towards things like retirement savings and what have you. And then lastly is the interest rate on any debt that you do have, right? I mean, that's important because the interest rate is the cost of that money. So the higher the interest rate, the more the cost is for that particular debt. So in order to determine what that is, then you need to look at your statements and ultimately put your cash where the cost is the highest. If you've got a credit card that's costing you 16%, then versus a mortgage that's costing you 4%, the reality is that on $1,000 on the credit card, it's costing you $160 of interest per year. $1,000 on the mortgage at 4% is only costing you $40. So try and eliminate the one that's got the highest interest rate. That's why that interest rate is so very important. So understand, these six numbers really break down into two different categories. How much, what your current monthly income is, your monthly cash flow, your Social Security, your retirement savings, all of that relates to sort of how much you're putting away along the way for your future retirement. The back three sort of deal with debt, credit score, debt to income ratio, and then of course interest rate. Those all deal with improving the debt side of the equation. So if you think of it in terms of assets versus liabilities, a very traditional way to think of any type of financial structure. I've got things that I own and things that I owe. It ultimately breaks down deeper into those six different numbers that we just talked about. So know your numbers, just like you want to know your blood pressure, your cholesterol, and guys, your PSA. You certainly want to know these numbers as well to improve your financial security. We'll take a break. When we return, we will continue the conversation here on the program with some tax ideas for the year 2020. Coming up next. Here we are in the fourth quarter of the year 2020. It's not too late, though, to do some tax planning, and you particularly might want to do that considering that there's a lot of folks talking about the potential for taxes to go up. Currently, we're at 100-year tax lows in terms of the tax rate, so if you were to make a guess as to which way taxes might be going in the future, it's probably up. So we're going to give you some ideas to help you improve your taxes that you can do prior to the end of the year here on the program. Welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you improve your life with a successful and cost-effective financial plan that provides you with superior investment results and peace of mind for the future. So what are some of the things you can do now, between now and the end of the year, to take advantage of these current low tax rates that we don't think are gonna be with us for much longer? The reality is that tax rates are at 100-year lows in this country. And with the backdrop of COVID and the amount of borrowing that has had to happen in relation to trying to deal with the economic impact of COVID, then ultimately you're going to see, I think, a higher level of taxes in order to sort of deal with these kinds of issues. So what are the things to be thinking about between now and the end of the year in order to improve your overall tax position, not just this year, but also going forward? And of course, first on that list would have to be the notion of a Roth conversion. When you have low tax rates, maybe even lower income than what you normally might have due to COVID, those tax rates that are set to expire in 2025 might very well expire earlier, particularly when COVID has increased this year's deficit by 3 times greater than what it was last year. The reality is, though, that when you convert an IRA to a Roth, you basically pay taxes on it at the time. So let's say you're converting $100,000 of an IRA over to a Roth. You are going to be reporting $100,000 of income and paying the tax on it based upon today's tax rates. When it gets over to the Roth, then the Roth grows tax-free, and at least for now, although there has been some suggestions in Washington that this might change in future years, there are no required minimum distributions on a Roth. So certainly some positive aspects to it, particularly with the combination of low rates, particularly with the features that a Roth has. But beware, make sure you really thought it out. Number one, you have to have the funds available to pay the taxes. So if you convert $100,000, make sure that you've got $20,000, $25,000 sitting over to the side that you're going to be able to then use to pay the tax bill. Because in contrast to prior years, where you had the option to undo that through the trick known as a recharacterization, that option to sort of undo your Roth conversion existed prior to 2018. It was eliminated and now not an option. So if you do a conversion, you don't get the opportunity to undo it. So number one, you got to make sure that you've got the money on hand to pay for the conversion amount. And then number two, be aware of the ripple effect. And this is the effect that having extra income could potentially have on your tax return. I remember a year or so ago, we had a long conversation with a individual that had listened to the program, and they had a very unique circumstance on their taxes. But what was happening is whenever they were trying to kind of run the scenario of doing a conversion, instead of paying like 15%, it always seemed like they were paying 30% based upon how much their tax bill was coming out. So basically it was like double what they were expecting to pay. The reality is what was happening is more of their Social Security was getting included as income, because more of your Social Security gets included in your income, the more income you have. So that meant that the conversion that they were calculating, I'm in a low tax rate, was rippling in on their return and causing more of their Social Security to be included as income, thereby doubling the tax impact of the conversion. Just this past week, we saw a similar type of example that involved rental property. Understand that you have to be below a certain income level in order to be able to have your rental losses, like depreciation and the like, be written off against your income. If you're above it, you don't get that write-off. In this particular case, they were able to maximize out the rental loss, which is up to $25,000, and been doing that because they have bought properties relatively recently, fixed them up, had a lot of depreciation to write off. So that was a nice write-off. The IRA or the Roth conversion that generated income on their tax return would have caused that to disappear, again, thereby doubling the tax impact of the cost of the Roth conversion. So bottom line, make sure that you really understand the ripple effect on how that's going to affect and impact your particular taxes. Next up, qualified charitable distributions. We've certainly talked about this on the program before, but they continue to bear repeating. What a qualified distribution is, and by the way, that's still allowed for this year, 2020. So this year, where you had the option to suspend your required minimum distribution, this year only, COVID special, if you will, then what you could still do, though, is you could still do a qualified charitable distribution even if you have suspended your required minimum distribution. So what a qualified charitable distribution is that you take money out of your IRA and you direct it directly to a charity. The beauty of that is that you wind up getting a front page deduction on that charitable contribution. In the past, where you've had to write your charity off on your Schedule A itemized deductions, these days, many Americans, like 90%, aren't able to do the standard deduction because the standard deduction increased a couple of years ago. And so consequently, most people don't get a direct savings impact for making a charitable contribution. If you do a qualified charitable distribution, you get that direct savings impact offsetting that amount of money that came out of your retirement account, and you don't have to itemize to do it. So you get to still take the standard deduction, and then the amount of money that you took out that went directly to the charity, that winds up being offset by the amount that you gave to your charity. So if you took $5,000 and sent it directly to the charity, that $5,000 is not going to appear on your tax return as income. So even though the required minimum distribution rules have been suspended, it's still an option. Even though the Secures Act increased the required minimum distribution age to 72, it's still an option if you are over age 70 and a half. So know that that option exists out there. Very powerful, very useful planning tool to do between now and the end of the year, to the extent you're making charitable contributions or charitable distributions. Side note on that, the CARES Act actually added a $300 charitable giving amount that you could do as a front page deduction, regardless of whether you itemize or not. So those are certainly some of the things to think about. We'll have a couple more to share with you next week on the program as well. In the meantime, we're going to wrap it on up and get on out of here. Thanks for listening to the program. This is Joel Garris of Dollars and Cents here on News Radio WFLA Orlando.